Hello everyone, it is Sterling here from Day Trading Forex Live, and in this video I'm going to show you what I believe to be the 4 most crucial or important aspects to becoming a profitable trader. Now I term this as a Forex beginner's guide, and the reason I do that is because when I think about if I could take my 13 years of experience in trading, I started trading at 17, I'll be 31 shortly, so a little over 13 years, and if I could take all that information and boil it down to the most important aspects, what would I teach myself at the beginning? What would I teach myself to help me expedite the learning process? Because for me, it took me about 3.5 years before I was consistently profitable. And it wasn't until my mentor personally taught me these 4 aspects and really ingrained into my mind the importance of these aspects. And what has been unique over the last 13 years of my trading is that after I implemented these in my trading, that was literally the turning point for me in my trading. And it had nothing to do with strategy. That's the other aspect. But what was unique about it is that every single profitable trader I have met in that period of time has followed these 4 rules to a T. I mean, they might make slight variations to it, but they follow the sentiment of these 4 rules. And so what I'm telling you is if you are struggling right now, you're new to the market, maybe you've been around the market for multiple years as well. It's not just a beginner's guide for those that are new to the market, but also a beginner's guide for anybody that's not profitable. If you're not profitable, then the fact is you have to make some changes. If you want different results, you have to perform different actions. So what I'm going to show you today is the 4 crucial rules to turning your trading around. And what we want to do before we get into that, I worked on shortening this video, but the fact is, guys, I don't want to shorten this video just to appease those that don't have an attention span. So what I've decided to do is make it as long as I need to, and quite frankly, if somebody doesn't have the time to stick around, then you're probably not going to have the patience to be a profitable trader. So the first thing I want to cover is why mindset is so important, because these 4 rules, although not strictly mindset related, they go back to mindset. The reason they're so important is really illustrated in a guy named Roger Bannister. It's probably a guy that many of you have never heard of, but he was the first guy to run the 4-minute mile. Now you might be thinking, what does the 4-minute mile have to do with learning to trade Forex? Well, what's interesting about the 4-minute mile is that up until Roger Bannister ran the 4-minute mile, and I believe 1956 or 53, right around that time, nobody had ran a 4-minute mile on record up to that point. But what's unique about that is that within the same year he ran the 4-minute mile, some 16 or 17 other traders or runners around there had ran the 4-minute mile as well. So what was it about him running the 4-minute mile that suddenly allowed all these other runners to do it as well? Well, it's right here. And the point I'm getting at is that it wasn't their training or anything else that changed. It was the simple fact that they now believed with 100% confidence that their goal was achievable because they saw somebody do it. They saw Roger run that 4-minute mile, so they knew for a fact it was possible. Because they knew it was possible in their mind, that was what facilitated the physical action. Now, I'm not telling you that positive mental attitude is the key to trading success. Anybody that's telling you that is just blatantly lying to you. That's not the case. But what I can tell you is a negative mental attitude, whether knowingly or unknowingly, and I'm going to explain how it can be. You could be having this negative attitude affecting your trading unknowingly, but whether you know it or not, negative mental attitude or a negative mental attitude has a dramatic impact on your trading. I want you to think about any time in your career to this point, you're in the time you've been trading, maybe career is not the best word, but I want you to think about any time you've achieved some level of success. Maybe that's a couple weeks of profitable trading, or maybe that's 5, 6, 7 trades in a row, winning trades in a row. What inevitably creeps into the back of your mind? Now, I'm no different than you, so if it's creeped into my mind at that time, I know it did as yours as well, because as humans, we tend to be very, very similar on core, basic human nature aspects, and that's what this plays on. And what creeped into my mind was Oh, I wonder when this winning streak's going to come to an end. Oh, I wonder when I'm going to blow up this account. Or you just had an uneasy feeling about those 5 profitable trades, or about that 2 weeks of profitable trading, or whatever it may be. You had an uneasy feeling because you have a history of failing prior to that success. So the subconscious mind has seen this 20, 50 other times, or however many other times. The longer you've been trading, the more baggage there is. So what the subconscious mind has seen is it's seen success and then a blow up, success and then a blow up. So what happens when you have that success? Well, your mind goes, oh, I've seen this before, also seen what comes next. And that's when those negative traits start coming in. That's when you start revenge trading, over trading, all the other mental aspects, or all the other aspects that come along with a mental failure or a mental breakdown. So what we want to do is I want to change what you perceive to be the keys to success. Because in your subconscious mind right now, and again, the longer you've been trading, the more baggage you have, the more important this is for you. So changing that perception of success, what that does is that gives your mind a new goal. And if your mind has a new goal of what it takes to be successful, you don't have all that other mental baggage, or it's pushed off to the side in the most effective way we can. And that's what I'm going to show you today. I'm going to show you the 4 keys to successful trading. You're going to think that these are much lower than what you've sought for, or what you've shot for prior to seeing this video. And so because they're much lower than what you shoot for right now, your mind is automatically going to put you in a state where you go, yeah, I believe that's possible. And that's going to make sense here in a second. But just because you believe something's possible, you have to also know that it's extremely profitable as well. Otherwise, in trading, what's the point? I mean, we're all here to make a profit. So I'm going to show you the 4 rules that you should use to guide your trading. And number 2, because you're going to think these are much lower than average, except for one of them, which we'll talk about. But number 2, I'm going to run the numbers on exactly how that would grow an account. So let's get right into it. What are the 4 aspects? Well, they're very simple here. And number 1 is win-loss ratio. I'm going to break all these down one at a time, and then I'm going to run through the numbers. So win-loss ratio, I want you right now, whatever your idea is of what a successful trader does, I want you to change what that perception of success is, or what you perceive to be the key win-loss ratio to success, and I want you to change it to a 50-50 hit rate. Now again, I don't claim to know what's in your mind, but over the last little under a decade of educating traders on the way that I trade, the bank trading strategy, personally, is that this number, again, I don't know what's in your mind, but I know that 80 to 90% of traders shoot for, it's probably actually upwards around 90%, shoot for a number higher than this. And they shoot for a number higher than that. I'm not saying wrong or right, I'm just saying they do. And that's having spoke to 15 or 20,000 traders over the last decade, 5,000 of which are members of Day Trading Forex Live alone, and probably another at least 10 to 15,000 other traders. This number is statistically way on the low side. Most people are shooting for a number much higher than that. Number 2, this is the only number of the 3 that in my experience, having talked with those traders over the last decade, is going to be statistically higher than what either you shoot for or you achieve, and that is a 2-to-1 reward to risk ratio. All that means is very simple. If you're risking 20 pips, you're looking to gain 40. If you're risking 100 pips, you're looking to gain 200 at least. We're talking about 2-to-1 reward to risk ratios. Or you could think about that in terms of percentage gain or loss, which we will here in a second. So if you're risking 2% of your account value, then you would be looking to gain 4% as your take profit. What this does is this allows this, and this is extremely important. A 50-50 hit rate is extremely important for one reason. Well, not just one reason, but one reason I can illustrate very quickly. If I went to you and I said your life depends on you winning 70% of your trades this month, and you have to take at least 12 trades. So your life literally depends on you hitting 70%. Now I go to you and I say, that's option A. So your life depends on you hitting 70% of your trades. That's option 1. You can choose that option. Or option number 2, your life depends on you winning 50% of your trades. Option number 2, which one are you going to take? You're going to take option 1 or option 2 if your life depends on it. Very simple way of illustrating that your mind instantly believes this is much more achievable. So I've just changed what you're going to go into the day, what your mindset is going into the day. We're going to, again, we've got to run through the numbers first, but then I have to show you how profitable it is. Once you see how profitable a 50-50 hit rate can be, then you're going to go into the day with not only the belief that it's possible, but also it's possible and it's hugely profitable. So number 3, limit the number of trades you have per week to 3 trades. You can increase this number down the road, but in the beginning, stick with 3 trades as your max number of trades in a given week. There is an inverse correlation for certain between the number of trades somebody takes and their probability of success. The more trades somebody takes, the lower the probability they are a successful trader. Again, you may be the anomaly, but I can tell you after dealing with close to 20,000 traders over the last decade, that is a statistical fact that consistently holds true. I know a lot of people that own brokerages, that are major parts in brokerages. This number is consistent among many more than just the 20,000 traders I've spoken to over the years. So limited at 3 trades per week. Number 4 is risk per trade. Again, these 2 numbers are going to be lower than what most people shoot for. 2% risk per trade means if you have a $1,000 account, you're going to risk no more than $20 on that account. If you have a $20 per trade, if you have a $10,000 account, which is what I'm going to run all the figures on here in a second, you would risk no more than $200 on any one given trade. So these are the 4 aspects. Now this might seem, Sterling, this seems overblown. You're calling this, the 4 crucial rules to success. But let me show you what this does over the course of time. Now I'm starting with a $10,000 account balance here. And we'll get to that in a second. I'm going to illustrate how you can get to the point where you have an account balance that's you have the ability to grow. In other words, if you don't have any money, how do you get money? I'm going to cover that as well here in a second. But let's go over those numbers I just showed you, those 4 crucial aspects to success. What do they produce in a month? Because we have to know what they produce in a month to then compound it month after month for 1 year, 2 years, 3 years. 3 trades per week equals 12 trades in a month, right? So if you win 50% of them and you lose 50% of them, you're going to lose 6 of your 12 trades and you're going to win 6 of your 12 trades. We're risking 2% per trade, so 6 losers times negative 2% equals negative 12%. You're going to lose 12% on the 6 losing trades out of the 12. On the 6 winning trades out of the 12 trades total, you're going to make plus 4% on each trade. Remember, 2-to-1 reward to risk ratio. So if you're risking 2%, you're looking to gain 4%. 4% times 6 trades equals plus 24%. Plus 24% on your winners minus negative 12% on your losers results in a plus 12% monthly gain. So on those figures I just showed you, it's a plus 12% monthly gain. Now what I'm going to do is I'm even going to shoot lower, because I'm going to walk through actually 3 different examples of compounding over the course of time. This is with even lower numbers. So what I did on this scenario or this slide here is I went off of, okay, well, we did 6 out of 6, we did a 50-50 hit rate, but what if you won only 5 out of your 12 trades? So that means you lose 7 trades and you win 5 out of the 12. That's a win-loss ratio just a little bit under 42%. So you're not much over a 40% win-loss ratio. What does that equal? 7 losing trades, again 2% risk per trade, means negative 14% on your 7 losing trades. On your 5 winning trades, again 2-to-1 reward to risk ratio, you're making 4% each trade. 4% times 5 trades equals plus 20%. Plus 20% minus negative 14% from your losers results in a combined total of plus 6% on your trades. Now I ran the numbers on plus 12%, plus 9%, and plus 6%. You've seen the numbers for plus 12 and plus 6, but a way you could get to plus 9% using this exact figure here is if you just change the risk from 2% per trade to 3% per trade. I don't highly recommend that, but if somebody were to do that using a 41.6% hit rate as I've illustrated here, 7 trades, again 3% risk on those trades, would instead be a 21% loss. And then 5 trades times plus 6%, because you're risking 3%, so you'd look to gain 6%. 6% plus time, or excuse me, 6% per trade times 5 winning trades would equal plus 30%. So if you took plus 30% minus negative 21 from the winners, that would come out to plus 9%. So that would be another figure you could run with a slight variation of the numbers that I'm illustrating. And that's why I said at the beginning, while every profitable trader I know follows these rules, they don't follow these rules to an exact T. They might make slight variations, normally even more conservative though than the numbers I showed you, not more aggressive. Okay, so let's go ahead, and right now what I'm going to do is I'm going to change over to the next slide here. And this is where I've actually broken down the numbers. So this is where, again, it's important to understand why all those other rules are in place. So for example, the win-loss ratio, we illustrated why that affects your mindset going into the day. The 2 to 1, that was the win-loss ratio. The reward to risk, that is really a key to profitability, because if you have a 50-50 hit rate and a 1-to-1 reward to risk ratio, well, you're break even at best. You're losing money because of the spread. So at that point, that your 2 to 1 is to offset for your lower win-loss than most people search for. And then you have 2% risk per trade. That's there so that you're not so mentally tied to any one trade. You can be disciplined, you can be patient, all things many retail traders lack. And then number of trades, that limits you so that you are not sitting there revenge trading or over trading or boredom trading. You know you only have a limited amount of trades per week. You're going to be more disciplined. You're going to be more patient as you wait for those correct setups. We then did the math on those numbers, and we found out that on a 50-50 hit rate with a 2 to 1 reward to risk ratio, taking only 12 trades per month and risking 2% on each individual trade, it would grow at a 12%. It would result in a 12% growth per month. Now we're going to take 12% per month, and we're going to compound that month after month after month to see what it would equal after 1 year, 2 years, 3 years. And we're going to do that on the 12% per month figure, the 9% per month figure, and the 6% per month figure. So on a 10K starting balance, and I'm going to start off by saying, you might look at that and say, well, I have $100. Use whatever number you have in these calculations. Maybe it's 100,000, maybe it's 100. The other point that I would make is everybody looks at this as an insurmountable number, meaning getting a starting balance. Learning to trade profitably is the much harder part. If you are a profitable trader and you just don't have the money to trade, shoot me an email. That's the easy part. I mean, getting you money to trade it's not even a problem, really. The problem is becoming profitable. Once you're profitable, again, if you don't have the money, shoot me an email. We'll figure it out. We'll get you the money. So that's not an issue. The issue is getting to this point where you can compound the account month after month. So what does it do after the course of a year? If you compound a $10,000 account by 12% per month for 12 months, it would come out to $38,000. Sorry. You do it over the course of 2 years. What does a account compound to at 12% per month? It compounds to over $151,000. Now at the end of the third year, it compounds to just shy of $600,000. Now think about that for a second. What does the 37th month produce? Well, 12% per month, 10% would be $59,000. 10% of that's $59,000. So 12%, you're talking another at least 10, 12 grand on top of that. So, 71,000, 70,000, somewhere in that region. The point is, it's a huge monthly number once you're at that point, even on those figures. So once you're somewhere around this number, once you're crossing 6 figures, you're probably even going to be dropping your percentage risk down lower to 1.5% or 1% risk per trade. That's what I do personally. I don't use 2% risk per trade. I use a number that's lower than 1%. And once you're crossing these type of figures, you're probably going to do so as well. But even on half of that, I mean, you can see what I'm talking about with compounding an account over the course of time. That's why Albert Einstein called compound interest the 8th wonder of the world. You can't make the type of money for your account that steady, consistent, compounded growth can make you. And what I mean by that is you can't take a $100,000 account and just start making 50, 60, 70% per month. You might be able to do that, sure, anybody can do that for a month. but you're not going to do it for a year. The best traders in the world, the best hedge funds in the world don't run those type of numbers. Nobody does. And again, anybody that's selling those type of numbers, you've probably bought into a few of them. I did myself, and it shouldn't be a shock to you that every single time they come up short. 9%, we did the figures on 9%. Remember, this was on a 42% hit rate with everything the same except for 3% risk per trade. At the end of 3 years, that equals $204,000. I'm not saying that this is easy. That's not what I'm trying to illustrate. I'm not trying to illustrate that you should expect this. I'm not trying to illustrate that anybody can do this. But what I'm saying is that your best chance at success is following the 4 rules I implemented at the beginning and then concentrating on steady compounding over time. Using the final numbers, let's see what the final number comes to. Final number, 6% per month. At the end of 3 years on a $10,000 account balance, if you compounded it by 6% every month for 3 years, it comes out to $81,000. Well, what's 6% growth on $81,000? So what would your 37th month look like? Just so you can see what a monthly profit would be. Well, 5% on, let's say, $80,000, 10% would be, actually 10% would be $8,000. So 5% would be $4,000, and we're dealing with 6, so it'd be a little over that, somewhere around the $4,600, $4,700 mark would be what the next month's profit was. So a $4,600, $4,700 monthly profit at that point. Now, to put this in perspective, because the comment I'll always get, and what you're probably thinking is, well, God, I had a much shorter time horizon when I came into this market. I thought I could take my $100 or my $1,000 and turn it into $100,000 in a matter of weeks or in a matter of months maybe. But a matter of years, that wasn't what I was after. And it probably wasn't what you're after, just to be honest with you. It probably wasn't. But up to this point, you've probably seen that the get-rich-quick idea is just not working. So what you can do, because 36 months is going to come whether you like it or not. As you guys know, and if you're anywhere above the age of 30, you probably understand how fast time accelerates. I'm only 30 years old, and it amazes me how fast time accelerates the older I get. So the time is going to pass, guys. It's just a matter of where you're at once this time passes. If you continue down the same path you're on, then it's going to lead to the same results. If you break from that path, you sit down with a pen and a piece of paper and a calculator, you write out your starting balance, and you write down 1 month, 2 months, not 1 year, 2 year, 3 year, but first month, second, and go all the way through, say, 5 years, compounding it by a number that sounds reasonable to you based on the four rules I talked about in the beginning, and seeing what that account will grow to over 2 years, 3 years, 4 years, 5 years. And what you'll find is that you'll see just how quickly an account will grow, how rapidly it'll grow. So what are the 4 points I want you to take away from this video? Again, I don't care what strategy, what time frame you trade. Strategy does play a little part, which I'll talk about here on point number 5 in a second. But there's the 4 main points, and then I'll illustrate number 5 here in a second. Number 1, accept a 50-50 hit rate. It is far easier to have a low win-loss strategy, a low win-loss, high risk-reward strategy versus a higher win-loss, lower reward-to-risk strategy. In my opinion, it is also more profitable. If you want to prove this to yourself, do the math on something. Do the math on a 70% win-loss ratio and a 1-to-1 reward-to-risk ratio compared to a 50-50 win-loss ratio and a 2-to-1 reward-to-risk. What you'll find is that the 50-50 hit rate with a 2-to-1 reward-to-risk is far more profitable than the trader that won 70% of their trades on a 1-to-1 reward-to-risk ratio. And what I can also tell you is that the initial thought will be, well, what about winning 70% of your trades on a 2-to-1 reward-to-risk ratio? And to that I say, good luck. I'd love it if I had a strategy that did that, or if I knew of a strategy that did that, but the fact is it just doesn't work out that way. When you offset for one or the other, you will minimize one or the other. So if you're increasing reward to risk, you're going to decrease win-loss. That's just the way it works. So that's what I want you to shoot for right there, because it's far easier to be a successful trader with a low win-loss, high reward to risk strategy. Number 2, these two go hand in hand. So if you have a 50-50 hit rate, you got to have a positive reward to risk. 2-to-1 as a minimum on your reward to risk ratio. Number 3, Limit the number of trades you're going to take a month. There is for certain an inverse correlation between the number of trades you take and your probability of being a successful trader. That is a statistical fact that I've found true over the last decade of educating traders, dealing with at least 15,000, probably closer to 20,000. That correlation stands true almost every single time. And the fourth point here, the fourth point that I covered was the risking 2% of your total account balance on any one given trade. No more than that 2% risk is my preference. If you want to go a touch higher than that, I mean 3% would be kind of an absolute cutoff. For any account over 20K though, I consider that type of risk way too high. Personally, I would prefer to see people at that 2% or under number. We ran the figures on all sorts of calculations so you can see that and really get a feel for what you need or what you want to have as your goal. Number 5 is strategy. Now, I didn't talk a whole lot about strategy through this video because in my opinion, strategy is a smaller portion of what it takes to be successful than these 4 right here. These 4 are really the critical one. But not every strategy is designed to have a high reward to risk ratio setup. There are many strategies that are just simply not geared towards higher reward to risk trading. So you need to examine your own trading. The Forex bank trading strategy, which is the strategy that I came up with and taught and still teach, that strategy is designed to capitalize on reward to risk ratios. We don't run really high win-loss ratios. We probably average 50-55%, and with those type of numbers and a positive reward to risk ratio, it's hugely profitable. But, and with that being said, you have to have a strategy that is designed to capitalize on reward to risk. So if you find that your strategy is just not designed to capitalize on reward to risk, then you need to start looking for something that is. Maybe it's the day trading Forex Live bank trading strategy, or maybe it's another strategy. Whatever it is, it needs to be able to capitalize on reward to risk. It needs to be designed to capitalize on reward to risk. Well, I hope you enjoyed this video, guys. This is going to be the first of many videos of me in front of the camera. I got a new setup for doing some of these videos. I think they'll be useful, walking through some tips and tricks, different things I found over the last 13 years of trading that I wish I would have known in the beginning. And so I'll probably be doing a tip series, some other things. If you have any ideas, things you would like covered, feel free to leave it in the comments section below this video. Definitely leave a comment, ask me any questions that you might have as well. Like, subscribe, yada yada, all that, and I'll see you all back for the next one. Until then, happy trading.